Testing. Oh, there we go. So, Greg and Jennifer, can you hear me?
Yeah, loud and
Yes,
clear.
loud and clear.
Okay, and we can hear you too. That's fantastic. Okay. Are they coming out of both sides of the stage or just over here? Both sides. Fantastic. Okay, good. We're all right. Great. So, are we good to go? You think so? Okay. Can you bring? Do you want to bring the house lights down just a little bit? Okay, no problem. No problem. We're good. Hey, Seb. Okay. Got it. Okay. Yeah, and you'll bring them back up from the console, I guess, right? Yeah, perfect. Okay, great. All right. And a little bit of audience just to house. There we go. Great. All right. Thank you. All right. Thanks so much. Thank you for your patience, everybody, and very warm welcome. And thanks for coming out tonight. My name is Ben Johnny. I'm an associate professor at the School of Architecture and Urbanism at Carleton University. I teach housing design, history of housing, and urbanism courses. The idea for this particular series came from my colleague Pallavi Sarangeli, who is a former Carleton PhD, received her PhD a few years ago, and has been working with a group called the Canadian Centre for Mindful Habitats to do a bunch of programming. She brought the idea because she, being a millennial herself, was very interested in some of the barriers that millennials are facing with respect to home ownership, and we then got ULI involved. Oh, I should mention that Pallavi runs the interior design program at Algonquin College. So the two universities linked up with Canadian Centre for Mindful Habitats and Urban Land Institute Ottawa. So Evan Garfinkel is here from ULI Ottawa tonight. And we all applied for a SSHRC grant, SHRC grant, and got some funding to mount this series. The idea of the series was really to kind of demystify a little bit this whole issue of home ownership, to kind of look at it from an affordability perspective and also from a financing and a design perspective, and then finally from a sustainability perspective. This is our third session, and it's called Ownership from an Affordability and Financing Perspective. I think what we've done in the first two sessions is indicated how difficult ownership has become, largely from an affordability perspective. In the second session, we talked a little bit about what we do and how things could be designed differently, perhaps to address affordability. In this particular session, and this is one I'm very excited about, largely because this is an area that I'm learning a lot about myself, is to look at non-conventional mechanisms for financing and indeed non-conventional relationships ownership. So I think this is going to be extremely interesting to all of you because there are indeed a few of them out there that we think, if deployed correctly and perhaps in concert with each other, can help us to get over the affordability hurdle. So great. So we're going to move forward. I'm extremely pleased tonight to someone who many of you probably know already, which is Saeed Saya. I'll just read Saeed's bio here. He's a principal now at FOTEN. That's probably news to some of you because up until quite recently, he was Director of Housing Services at the City of Ottawa, but he's recently left public sector and joined the private sector. He has over 20 years experience in development and community planning, including over a decade of management experience working with multiple sectors in government in both private and not-for-profit sectors. And Saeed has held various roles, as I mentioned, including Director of Housing Services for the City of Ottawa, and he has extensive experience developing, coordinating, and implementing affordable and supportive housing projects and programs. So we're very, very pleased to have him tonight. I'm going to invite him to the podium in a minute. I want to say, though, after Saeed's presentation, we will move into discussion mode, and we have 3 panelists joining us tonight, 1 here in person and 2 are joining us online. As you can see, we're on Zoom right now, and this is part of our challenge with technology tonight. This is a hybrid model that we're experimenting with tonight. So our in-person panelist tonight is Mushtaq Kazani, and Mushtaq is the Chief Executive Officer at Habitat for Humanity here in the Greater Ottawa region. He has more than 20 years of business administration and nonprofit management experience, both nationally and internationally. Mushtaq is a keen social worker and has served various institutions within and outside community and ministries in the various countries in which he's worked, so including Canada, certainly Pakistan. And he speaks on topics for youth development, leadership, and lifelong learning, and how we corporately can contribute to society. So we're extremely pleased to have Mushtaq here in person. Now, our other 2 panelists, you can see Greg and Jennifer, you might just want to turn on your cameras for a second. So the first, there we are. The first of which is Jennifer Tsao, and Jennifer is a senior specialist at CMHC's Housing Finance Policy Team, and she launched her career at CMHC in 2017 in Market Insights, where she published forecasts, authored research, and provided commentary on local market trends. She first became interested in housing while working as a co-op research associate at Royal LePage. And Jennifer, when the folks at CMHC first put us in touch with Jennifer, I just assumed she was here in Ottawa and only recently discovered she's based in Vancouver. And so she's patching in by Zoom tonight. And then last but not least, we have Greg Banfield joining us. Greg is the Director of Mortgages and Program Delivery at an organization called Home Ownership Alternatives, or HOA. And he has the primary responsibility for the origination of quote-unquote extra help mortgages for home buyers, mortgage risk management, and reporting to regulators and agencies, and to HOA's funding partners, communications with mortgagors, and the administration of HOA's growing portfolio of alternative mortgages. He possesses many years' experience in mortgage origination, sales and marketing, staff development, and the administration of mortgage portfolios, making him extremely well suited to assist with the financial analysis and decision-making processes essential to creating and managing diverse partnerships with builders, development consultants, and varied sources of funding. Gregory's a licensed mortgage professional, and he holds a certificate in financial planning. Gregory has an MBA in strategic management and entrepreneurship and an undergraduate degree in economics. Great. So those are our panelists tonight. And I'm going to invite Saeed up to the podium to give a presentation. Among other things, Saeed is going to talk about programs that he was involved with at the City of Ottawa, and then introduce us to this whole kind of wider realm of alternative financing options and alternative ownership options. And then he's going to call on Mushtaq, Jennifer, and Greg to talk a little bit in greater detail about the options have to offer. So I think we're going to learn a lot tonight. I'm hoping that the millennials in the crowd, and I'm seeing a bunch of relatively young faces, which is good, are going to come away feeling a little bit more optimistic about access to ownership. But yeah, it gets a little bit more complicated when you partner with another entity to do your first home purchase. So with that, welcome, very warm welcome to Saya.
Okay, great. Thank you, Ben, for that kind introduction, and thank you, Ben and Pallavi, for inviting me here to speak and to moderate this session this evening. Tonight, we'll be talking about traditional financing and how that plays into what we build and how we buy homes. And from there, we're going to get into some innovative and alternative approaches as well with our partners. But before I start, I need to warn you that I'm not a mortgage broker, and I'm really not qualified to give any of you financial advice. Although my fellow panelists, I think they are, in a much better position to do that. I know enough just to be dangerous in this area, and I've been lucky enough to have different roles throughout my career to understand, a little bit from, all the different types of programs and from projects that I've worked on, how we can put some of these mechanisms together to make housing more affordable for millennials and moderate income households that are looking to purchase or buy their own home. Next slide, please. Okay. So to start, I want to provide a quick recap from session 1 of this series, and I borrowed these first couple slides from Ben, just to talk about why do we promote home ownership. First of all, homeownership helps create wealth, it promotes self-sufficiency, and it relieves governments from further obligations of subsidizing its residents. And ownership, more importantly, creates a very healthy middle class. Keeping people out of homeownership also prevents them from accumulating wealth. And I think a lot of you, especially when we talk about millennials, you've probably witnessed your parents, in the past, be able to afford homes at much lower prices. Interest rates may have been high depending on the decade, but they were able to pay down those mortgages and see a really quick appreciation of that home's value. But one of the key principles really is wealth accumulation that comes along with home ownership, and this is what really defines many developed economies. And it's a real key mechanism because in the past, for those of us who've looked at savings, for example, we know, and I think I remember from my younger days, it can be hard to save, when you're in your 20s or 30s for that down payment to buy a new home. And I'm not going to talk about rental housing. Part of me wants to sort of jump in there and talk about the importance of affordable rental housing. I'll avoid that. But again, it's really about, how do you get into the homeownership market and accumulate some wealth that you can use towards retirement and so forth. Next slide. So one of the challenges we have when we talk about housing and affordability is, and we're still recapping here, is, we often refer to income brackets and house prices, and we need to be very clear about what we're talking about. So when discussing housing policy, you'll hear terms like income deciles, quintiles, middle income, low income, moderate income, but what does this all mean? And for our purposes, we're really looking at incomes between $60,000 and $110,000, and house prices ideally anywhere from $285,000 to $500,000. And I know this is, these are hard sort of parameters to accept in today's housing market, especially when you look at the cost of new housing and the cost of some specific types of housing in specific neighborhoods. We know that the average price has gotten to be quite high, but we'll look at some of these examples as we go on. Next slide, please. So this is just another chart I have just to try to illustrate the affordability problem or opportunity, depending where you are on the income stream. So this graph shows a breakdown, in this case, of income deciles. That's in segments of 10, corresponding with the affordable home prices. So this was taken from StatsCan data, and it basically matches Ben's analysis from session 1 that shows how house prices are really starting to gradually move out of reach for what many households are considered to be moderate or middle income households. And without spending too much time on this slide, you could see for single detached houses, for example, and this is 2019 data, so it's much more severe now. This is in 2019, 2020, you're looking at the 9th or 10th income deciles to afford a house that's with an average price of around $635,000. Next slide. Then further, when we talk about income, I'd like to try to make it a bit more practical in terms of, how we can think about what incomes look like and how they work. So another way to think about incomes is by wage or profession. And we know Ottawa's got fairly, robust incomes. We've got of course, the seat of government. We've got a, robust high-tech sector and so forth. But just looking at some Ontario wages, if we look at minimum wage, we're looking at about an income of $30,000 a month per individual or household. Service retail sector, maybe $41,000, depending on the sector itself. Construction worker, around $60,000, although again, given some of the inflation, it's probably a little bit higher now. Dental hygienist, I found an average income of $73,000. Professional wage for entry-level professionals getting into, government or other professional sectors, it's around $80,000. And what we've got here is maybe corresponding maximum rents that people with these incomes would be expected to pay. So we're looking at, anywhere from $756 a month to $2,000 a month for a particular unit. Next slide. And then when we combine people to make up different sizes of household, this complicates again what compromises a household and what their income looks like. So you can have, an individual with with an income of $80,000 or one of those other wages that I had mentioned. Two individuals making $100,000 or more. Then you throw in children. This impacts, of course, the size of home people need to access. And as you're well aware, the larger the home, the more costly that's going to be. So we have to keep all of these things in mind. Next slide. Okay, so now I'm going to get into how some of these, how mortgages work. And just before I talk about some of, the alternatives and innovations that we're going to explore during this session. But before I do that, we all have to be on the same page with specific mortgage terms and definitions. And that's because I'm going to spend a lot of time talking about second mortgages, because that's a really key piece of one of the key pieces when we talk about affordable home ownership. So the first one, the first component is the down payment. So it's the amount of cash you put towards your home or property to purchase that indicates to lenders your financial commitment in securing a mortgage. The term. I'm not going to get into variable or fixed mortgages, but for the purpose of this presentation, I will be assuming fixed rate mortgages for a 5-year term. But again, the term of your mortgage indicates the stability of that interest rate. So if you have a 5-year term, your interest rate is fixed for 5 years or 10 years. That's the term, and your payments should not change within that period. The amortization period, that's the length of time you have to pay off your loan. So it's different from the term. The term is the period of time where your interest rate is fixed. And at the end of that term, you have to renegotiate with your bank or financial institution, or you can go to another bank, whatever you like. But maybe you extend your amortization period again. But when you take out that original loan, it's based off paying that loan over a 25-year period. Now, when I talk about first mortgage and second mortgage, the first mortgage, and for those of you who own your own homes, you'll know what I'm talking about. This is the amount that you borrow to buy your home, and it's registered on the title of your property. This is the portion where you pay down the principal. You pay your principal and interest each month, and the principal starts to come down. If you default on those payments, because that mortgage is in first place, it's the first mortgage, that's what gives the bank the right to foreclose on your home and sort of take over your property. So you don't own that home anymore once you default on the mortgage. And then there's this whole concept of second mortgages. And those of you maybe in the real estate business or developers, you might be familiar with this. But a second mortgage is just almost exactly what it sounds like. It's about being in second place. It's behind that first mortgage. So if you buy a house, your first mortgage is $400,000. Maybe, if the second mortgage is $100,000, it's literally behind that. And I'll show you some examples. But whoever has the first mortgage, they have first rights to that property in order to sort of get some of their cash back. So if they sell the house and there's $400,000 still owing to that first lender, that primary bank, and and it only sells for 350, the first lender gets the 350, and whoever's in second place doesn't get anything, right? If the house sells for 500 and there's a $50,000 mortgage in second, 500,000, there's a $50,000 mortgage in second place, then the first lender gets 400,000, the second lender will get their 50,000 back, and then there's 50 left over maybe for the household that defaulted on their loan, but that's between the homeowner and the lawyers at that point in time. Next slide, please. Okay. And again, I'm kind of starting with basics here because we're going to be talking a lot about mortgages and mortgage instruments. So when we look to combine household salaries and the ability to purchase a home, this is sort of what we see. And you can get into much more detail with other mortgage calculators and so forth. So in this particular case, we've got a couple with a household salary of $100,000. And on this slide, you'll see two sort of maximum rents, one maximum rent and one maximum mortgage. And I started doing this based on feedback I used to get from developers and people who were buying and selling homes. So often governments and advocacy groups, we like to use the 30% rule. So what does that mean? That you shouldn't spend more than 30% of your household income. This is gross income before taxes on housing. So for that household that's earning $100,000, the maximum they should be spending on rent is $2,500. But when you look at purchasing a home, often what's acceptable to lenders is to go up to 40%. So in this case, if they're buying a home, it's considered acceptable, that they pay $3,333 a month. Now these percentages might be debatable, but I've got them up here just for sample purposes. And again, so the mortgage rate in this case is fixed for 5 years at 4.84%. This is just sort of what we're seeing in terms of fixed mortgage rates now. A 25-year amortization period with a 5% down payment, factoring in property taxes and so forth. We're looking at a total monthly payment of $3,328. Now, this is sort of and I forgot to mention this when I started. So one of the first, and I forgot to mention this because I think it was covered in one of the earlier sessions. The reason that you can put 5% down, and in this case 5% is about $25,000 down on a $500,000 house, is because CMHC, the Canada Mortgage Housing Corporation, will give a qualified household mortgage insurance to put less than 20% down. Your standard mortgage, you're required to have 20%. If you have 20%, you don't need the CMHC mortgage insurance, which means you don't have to pay the insurance premium, but it also means you need, in this case, $100,000 down to purchase the $500,000 home. And then again, you'll have lower carrying costs monthly, and when we factor in utilities and property taxes, we're looking at a carrying cost of $2,790. Next slide. And then here's the same example, but with a condominium. So we have an individual in this case earning $80,000. Again, we've got the maximum rent and maximum mortgage that they can afford, the minimum down payment if they're only putting 5% down, or the 20% scenario where they'd be required to put down $60,000 in this case. And then, what's different here is we've got condominium fees. And so we've got property taxes in addition to the mortgage payments. So, in this particular case, if the condo is selling for $300,000, your mortgage payments with 5% down are about $1,700 a month, or $1,696. We incorporate property taxes at $183, utilities at $150, and then I included the full condo fee. I think some banks might only include half the condo fee, but this is for a total monthly cost of $2,429 a month, right? Which exceeds the maximum rent, but is below the maximum mortgage. And I just want to point something out here, because again, just when we talk about house prices, and I had some slides here, but decided to remove them. If you look at existing house prices, you'll find that there are condos that are 1-2 bedrooms for $300 or less. There's some for $400, etc. But there is a difference between buying a resale home and a new home, and it's kind of like a similar analogy would be a car. If you're going to buy a brand new car, it's going to cost you much more than buying a car that's 10 years old. Now, housing's a bit more complicated than that, because if you're buying a home in Westboro that's very old, it's still going to cost you a lot, right? But it's going to cost you a lot less than a new home in Westboro. Right? It might cost you $1 million versus $2.5 million if I'm just making those numbers up, but they're probably pretty close to reality. So properties are very similar in that way. And I think there's another side of this that are probably being tackled in your other sessions, where you're looking at issues of supply and constructability to try to bring housing costs down. And in this session, we're really focusing on the financial solutions. And then coming back to this, the 20%, of course, you've got a bigger down payment and you've got lower carrying costs. So there is a bit of a benefit to that. Okay, so that's the basics. So let's go to the next slide, please. So now that we've covered the basics of how income and mortgages work, we'll spend some time discussing these alternative incentives and options. And we've decided to break it down into these general categories. So we've got shared equity programs. In this case, we're looking at mortgage contributions. And I'll be talking about homeownership down payment assistance programs and other down payment assistance programs that I've been involved in over the years. We're going to look at homeownership alternatives, and we have Gregory Banfield here to join us, and Habitat for Humanity as well. And these all fall, it's that world of second mortgages that I was talking about at the beginning. We're going to expand on that a little bit more. Then we're going to get into another type of shared equity model, which is really about land contributions. And we're going to look at private or for-profit equity contributions, and a little bit on community land trusts. We'll talk about CMHC's shared equity mortgage fund and their rent-to-own stream. We'll dive a little bit into borrowing against your RRSPs and the Canada's Home Buyers Plan, and then we're going to end on the rent-to-own option that's also available, or sometimes available, I should say. Next slide. Okay, so home ownership down payment assistance. This program, I can't tell you when it first originated, but I first encountered it in 2007, 2008, around that particular time during the economic crash. In this particular case, the component aims to assist low to moderate income renters and households to purchase affordable homes by providing down payment assistance in the form of a forgivable loan. And here are the objectives: to move renters, into an opportunity into home ownership, ease the demand for rental housing, so get people out of rental housing and into home ownership, so it'll create more vacant units in the rental market, and to encourage not-for-profit affordable home ownership developers to build more affordable ownership units. And we saw a little bit of a spin-off on this last point. Next slide. So the funding in this case was limited to up to $50,000 per unit, and it had to be secured on title to the land. So I'm getting back again to that second mortgage idea that I was talking about earlier. And then in almost all cases, there are conditions that are attached. So at this time, we're looking at the renter household had to be the sole and principal residence in what was called the service manager area. That's the provincial way of just saying municipalities or cities that are responsible for administering provincial programs in Ontario. And then there's always a maximum income limit. And they had indicated the 60th income percentile, which currently the province is treating as $96,000 for the city of Ottawa. And that's what was considered, again, a moderate income household. Next slide. So how would this work? So if you were eligible for the down payment assistance, and I'm using the same household, and forgive me, I just used the same incomes, but it's again to illustrate the concept here. We've got it's sort of further to the right where it's shown. So in this case, you're given $50,000, and I made a mistake on the slide. It says 20%, but it's not 20% in this case. It's 50,000. It's I forget the actual percentage, but and that's registered as a second mortgage, so it's still repayable, and that lowers your first mortgage to $463,900 something. You've got the mortgage insurance that's required there. I just show you the interest and the principal that's paid over the term. But at the end of the term, which in this case again is 5 years, you've paid your mortgage down to $409,000, and you still have that $50,000 mortgage. Now, what we found when we administered this I'm jumping ahead of myself. So in this case, the household would receive $25,000 or $50,000, depending on the situation, and that would be provided to them. They would be responsible for going out, though, and getting their own first mortgage. So they would get a letter from the city or whatever government was administering this, asking the lender to treat this $50,000 forgivable loan as if it were equity or cash, a cash asset in their bank account that they could provide as a down payment. Now, not all banks honored this, but most of them did. And again, they were responsible for having good credit and obtaining that particular mortgage themselves. They would go out and find their own home, and then we would register that $50,000 or whatever the amount was as a second mortgage, and it shows up there. So at the end of the term, they never paid us back. They don't have to pay us back after the 5 years. It stays there. And I'll talk a little bit about that later, but I just want to go to the next example. So if you use this example for the condominium purchaser, so again, we've got this individual with an income of $80,000. So if they received, down payment assistance of, let's say, $50,000 in this case, we could see what this would do to their, what kind of payment they'd have. It's actually a little bit lower than if they had, it's considerably lower if they had the 5% down payment. So it becomes much more affordable for them. They pay down the first mortgage over that 5-year term, and then at the end of the first 5 years, the balance on their home is $226,000, and that second mortgage is still there. It hasn't moved, right? They don't pay it. They don't touch it. They just have to live in their home, and there's no requirement at this point in time to pay that back. Next slide, please. Okay. So I think I went through some of the requirements there a little bit quickly. I just want to recap on a couple of them. So we talked about the eligibility, and it is a little bit complicated to have a second mortgage on your property. Now, if any of these home buyers chose to stay in their homes for 20 years with this particular program, the loan would have been fully forgiven. They would not have to have paid it back to the city. But we actually found that almost all the buyers after, within a 10-year period, repaid the loans back to the city. They didn't want to wait out the 20 years, and it was for various reasons. One reason was they didn't like having someone else looking at their finances. So every time they had to go refinance, they had to come to the city and ask permission to refinance. And, a lot of people don't want government in their business. So a lot of them, within the first 5 years, said, you know what, we don't want to deal with you. Not because the city was complicated, but because maybe they wanted to refinance their home, to a higher level than what the city would have allowed, because the city still has to protect that $50,000 investment in case they default on it. So in those cases, the banks saw that the households had better credit. They were making their monthly payments. They loaned them the money, and they paid back that $50,000, often with a little bit of appreciation. So the money came back to the city, which in turn reinvested that into new affordable housing. But some other lessons from this were, one, this was a very popular program. So it was released, like I said, during the economic downturn. We had immediate take-up. I mean, I think we had to close the program after 2 or 3 days because hundreds and hundreds of applications were coming in. And then the federal and provincial governments asked us to stop, and like most cities, because we were just getting flooded with applications. Yes. Yes, you do. So if you sold the house, you have to pay back plus a percentage of the appreciation. So in this case, the city, or you could say all 3 levels of government, would share a percentage of that increased value. Exactly. It's a combination of the increased equity and likely, better ability, better credibility for borrowing. Yes. Oh, I think our mics got too close there. Okay. If we could just stay on this for a second. Other, positive things, and if you talk to the lawyers that were responsible for this, and I know I get, some of this stuff is exciting to me, but the lawyers and the administrative costs, for this were very, very low. So there's a bit of a cost up front for governments to administer this, but the ongoing costs are much lower than other affordable housing programs because it's triggered automatically. You know, because you don't have to follow the household, right? They give you a letter once a year, to confirm that they're still the primary occupant. And if they sell or move or refinance, the banks and the lawyers have no choice. They have to come to the city because we're on title. Being on title is a very strong legal instrument. It's much stronger than just having an agreement, right? It triggers a lot of things. So it gives a lot of security, even though you're in second place. Talk about low upfront costs. It was often in many jurisdictions, it's first come, first serve, or a lottery system. That's just, again, because it's so popular. Very few defaults, so about over 300 households. We maybe had 2 defaults. I remember one for sure. I put 2 just in case, but there were very few defaults. And again, the vast majority were repaid. Next slide, please. Okay, so why didn't we keep doing this? I remember when this rolled out, there was a lot of interest from different governments. Being in Ottawa, we had a lot of delegations come to visit us and learn about different programs. And some governments did this on a much larger scale. Most of them were in Southeast Asia. But in Ontario and maybe in other provinces as well, a lot of the federal and provincial housing programs, they're delegated to municipalities. So this makes it, and there's some complicating factors here. They'll receive, in the case of Ottawa, but again, any other city, Toronto, Kingston, we're all the same. We receive what's called a transfer payment from the province, so it's federal provincial money, comes to the city, and it's usually under one specific program, and the city has to choose how to spend it. So the city could put it towards home ownership, but then this money is also for things like social housing. It's for building new affordable housing, new supportive housing to help people with mental health and addictions. And often it's not enough funding for those initiatives. And that's why cities don't do more of this, because they're not funded enough for those other, more critical pieces of housing and support infrastructure that are needed. And I could say this now because I'm not working for the city anymore, but it's really because, a lot of social services and housing responsibility was downloaded in the early 2000s from the federal and provincial governments onto municipalities. Specifically, and in Ontario, not just housing, but social services was downloaded onto municipalities as well. So that puts a lot of burden on the property tax base, and it creates challenges, and there's little incentives for cities to often push home ownership, because a lot of the benefits, the economic benefits, the tax benefits, they come through, provincial, federal coffers at a much higher level, not so much, a direct financial benefit for the city. So often we'd see this as a icing on the cake type of program, and given the fact that there wasn't enough funding, it wasn't something that was done very often after the economic recession. Okay, next slide. Okay, and then so we're just reflecting on what would be some of the challenges of having a similar program today. And when I was reflecting on this program, the average house price in Ottawa was under $300,000. So since then, it's more than doubled, and incomes have not more than doubled over that same period. So again, it's the rising house prices, and the fact that incomes have not kept up with the increase of the cost for housing. That's a major barrier. Next slide. Okay, so there are other ways too we could structure this type of idea, and this was done once, and I think, and Gregory might expand on this a little later, but we had done it again around the same period of time, where we used development charges to help with that down payment assistance. Now, what are development charges? They're a fee that's paid by a developer for whether it's a new condominium or any residential unit that's supposed to go to funding infrastructure soft and hard infrastructure costs associated with that development. And for certain developments, the city, within housing services, we try to convince the city and the finance department to forego that revenue and allow us to pass that on to qualified house buyers. So very similar to that down payment assistance program. And in this case, we had development charges. Well, actually, I can't remember what they were. It was a while ago, but I used today's development charges, which are between $25,000 and $30,000 on average for a lot of units. And we had asked the developer to match the reduction in development charges with a price price decrease for that particular unit. So if the city gave a reduction of development charge for one unit that was equal to $25,000, the developer would match that with a price reduction of another $25,000, and then that's how we get to $50,000 or $60,000 off of the purchase price of the home. And again, this gets secured on title, and this was really important for developers, because developers, we only worked with one developer, so I can't say this was really popular. It was Terran at the time, but they were, just like other developers, they were concerned. They said, well, if we drop the price and then people turn around and sell it, they're just going to get that $25,000 price drop that we gave them. So what we did in this particular case, we registered that fee forgiveness and that price drop on title. And then if somebody sold the home, again, within a specific period of time, we had 20 years, if they sold or they wanted to pay us back, there was just an interest rate attached to it. So we had a 5.5% interest rate, that I do remember. And again, all of the units have sold since within that particular project. And it was a great project. So the city got all of its development charges with 5.5% interest. Maybe it was deferred, the payment that came back. And the developer recouped anything that they would have otherwise lost with those sales, because they got that price reduction back as well when the units were sold. And again, most people didn't stay in their homes, or in this place it was a condominium, for the full 20 years. It was all repaid and came back to us. So again, very similar outcomes as with the homeownership down payment assistance program. Next slide, please. Okay, so now we're going to talk a little bit about homeownership alternatives, and we've got Gregory Banfield here, and again, homeownership alternatives is a very innovative organization, and that they still, they work on that whole concept of second mortgages to buy the price of the home down and defer that payment for the homeowner to a later date. So again, next slide. So Greg, if you want to jump in here and maybe talk a little bit about.
Thank you. So, thank you, Said. Homeownership alternatives. We're an equity provider, so we're twofold. We help housing with construction, them with loans to buy the land. The best way I like to explain it is, we forego, if we were a for-profit company, we give the profit to the purchaser that we would normally take, and we give it to the purchaser as down payment assistance. The mortgage that we put is a shared appreciation, and a shared appreciation mortgage is a mortgage that does not bear a specific interest rate. Instead, the interest that you pay on our second mortgage is based on the increase in value of the home from the time that the home is purchased until the time that you decide to repay the mortgage. So either when you sell it, or if you voluntarily decide to repay it. And that's how we calculate the interest based on how much the property has gone up in value. Next slide. The really good benefit of the shared equity program that we have, and the shared appreciation mortgage, is it helps to improve affordability, because it does not require the homeowner to make any payments of principal or interest, as long as they're living in the unit. They have to live in there as their principal residence. When they decide to sell the home, that's when the purchaser has to repay it. So there's a few points. So they can decide to when they want to sell their unit, when they want to voluntarily repay it, and if they want to pay it, and if they voluntarily want to pay it. So purchasers and homeowners can repay the second mortgage at any time without penalty. So it's a fully open mortgage. And the benefit of this is the purchaser can concentrate on paying down their first mortgage and building up the equity within their first mortgage. Next. So how does HOA make home ownership affordable? So in the Toronto area, I'm gonna use this example here. On a 3-bedroom condo, it's $650,000. They put a 5% down payment up to the first $500,000 and 10% on the balance. So that would bring their down payment down to $40,000. So without any assistance, the purchaser would require a mortgage of $610,000, and they would need a minimum income to qualify of $152,500. Now, when they come to HOA, if we gave them a 15% second mortgage, that second mortgage, they'd still come down with their $40,000 down payment. We now give them $97,500 in assistance. That brings down their mortgage, their first mortgage that they would need, to $512,500, and it more importantly drops their income down, the qualifying income, to $128,125. And the same thing, we layer on more assistance from our different partners. So, for example, the City of Toronto, or some municipalities, as Saeed said, they would give deferral development charges. So we would take those development charges and we would put it in as down payment assistance. So we layer it on top of our $97,000. So that gives the purchaser a second mortgage of $157,000, and it again lowers the income down to $113,000. So the more layers that we have in terms of assistance, the more assistance we can get to individuals, and the lower the incomes that we're going to need in order to help. In our final example, we have total second mortgage of $217,000, and it brings the qualifying income down to $98,000. So it makes it really, really affordable for the individuals. Now, people are probably saying, "Oh, these are big second mortgages that they have," but we found that even with a 5% increase in value, the ending purchaser equity grows to 18%. And say the property appreciates 25%, that purchaser equity grows to 26%, and which translates to a $211,000 in the purchaser's pocket that they're going to walk away from after they pay back their first mortgage and the appreciation on the second mortgage. Next slide. And this is just an example here. I think I spoke too soon before the slide. But initially, the purchaser's equity is in purple, and it's 6%. The partner assistance, meaning a municipality or any program funds, affordable housing program funds, works out to 19%. This is at the initial purchase. HOA has a 15% second mortgage in there, and the financial institution, the bank or credit union, has a 60% stake. So at the initial equity purchase, the purchaser has a 6% stake with just a moderate increase of 5% in value. That 6% equity stake grows to 18%, or $125,000. At a 25% increase, the 6% grows to 26%, or $211,000. So the program is really good in helping out people to gain that equity. Next slide. So the summary of the second mortgage. So Basically, the second mortgage supports purchasers who want to own a home, provides you down payment assistance. There's no scheduled payments, thus reducing the carrying costs and reduces the need for mortgage default insurance, which is the CMHC.
Excellent. Thank you very much, Gregory. So just to clarify, in this particular, in your particular programs, there are no payments on that second mortgage, correct? So if we go back maybe briefly just to the pie chart.
Yep.
So Gregory, so a household would only pay principal and interest on that first mortgage in this case?
Yeah, that's the beauty of it. When you come with us, even though you get our second mortgage, you only have to worry about paying back the principal and interest on your first mortgage. The second mortgage just will sit there, and you can decide, and you have the control of when you want to pay that back.
Excellent, thank you. And again, this is sort of showing the power of that second mortgage and how it can assist homeowners get into the market and pay for their home. And also it illustrates how it's really not a handout, because I think there's a lot of political barriers we'll probably talk about during the discussion, but there's a lot of views about, what homeownership down payment assistance is, and I think there's different ways that it can be structured. And one of the important facts here is that these households do pay back the cost of the home, but over, in a different way and over maybe not even a longer period of time, but just I think in a different order than what you normally would.
Yeah.
Okay, great. Next slide, please. If we can go to that. Okay, so now we're going to talk a little bit about Habitat for Humanity, who provides another pathway to home ownership, where a household doesn't require any down payment to purchase the home. And I think a lot of you are familiar with Habitat for Humanity, and we have Mushtaq Kazani with us tonight, and he'll be up in a little bit to join us for the panel discussion. But I did want to highlight, just briefly, Habitat's model. Next slide. So Habitat primarily has two models currently, and one is their pathways to home ownership. And this is a rental housing option with an option to purchase the model that will convert to home ownership after 20 years. The purchase price of the home will reflect the fair market value at the time of move-in, and after 20 years, families will receive title to their home, and the equity portion of their monthly payments will be applied to the purchase of the home at that time. And I think I was lucky. I got to work with Mushtaq and his team on one of these, and it was a bit of a negotiation with the province at the time, because we had received funding to build rental housing, and but Habitat sort of came in with the best project that we wanted to support, and we were able to make this work because we took the rental housing funding, which came with a fixed term from the province for 20 years, and we were able to convert that to a rent-to-own project, and the province agreed, and they agreed mainly for two reasons. One, because it was Habitat, and in some of their housing programs, the province of Ontario makes special provisions only for Habitat for Humanity. And second, because the proceeds of the sale go back into building more affordable housing, which Habitat is becoming much more sophisticated in doing. And then the other tool that Habitat uses, or the program they provide, is, and I really like this, it's the blended mortgage model. And this is where the first portion is an interest-bearing mortgage that will come from a regular financial institution working in partnership with Habitat. And then there's a second interest-free mortgage provided by Habitat that allows the homeowners to continue to build their formal credit history. And one thing that Habitat does with a lot of homeowners, because they're often working with homeowners who are a little bit more modest in the income bracket, I kind of like to compare Habitat, Mushtaq, to like a rent geared to income mortgage provider, so that if your income changes, if it decreases, Habitat is very good at working with you and the financial institutions to adjust the mortgage, to reflect your actual income. And they've been very successful at preventing any defaults of their properties and so forth. Next slide, please. Now, some of you might be familiar with some of Habitat's criteria. One is the 500 volunteer hours. that are required on the build site for eligible homeowners. And I often wondered if this makes them more maintenance savvy with the, once they move into the home in terms of, the upkeep and life cycle maintenance and things like that. But again, we're looking at more modest household incomes. Habitat focuses on a before tax income of $59,000 or less. They've got exemptions for children under the age of 18. I think we're calculating income profiles for households. You have to be a Canadian citizen or permanent resident, and you must be a first-time homeowner or a current renter, and again, able and willing to contribute those 500 hours. Ben, yes? Yeah, and most recently on the rent-to-own project, I know that Habitat was successful in getting some homeowners from OCH previously, for example, to be able to purchase a home and move into their newest build. Okay, next slide, please. All right, so now we're going to move towards another type of equity. In this case, we're looking at land leases. Now, a land lease is a home ownership model where people can own their homes, but without having to buy the land. These homes are typically 30% cheaper than the average price of homes in surrounding areas. And believe it or not, this concept's been around for quite a long time. I think it gets spinned in different ways recently, especially when we're talking about tiny homes or modular homes, maybe veterans housing for those of you who are sort of plugged into the housing discourse. But we'll get into sort of the acceptance of this model and so forth. But it is an option where, that actually helps to reduce the purchase price of that housing asset. Next slide. So this is an actual example from CapREIT, actually in Port Elgin, Ontario. And in this case, the land is going to be leased to the homeowners. The homeowners will pay a leasing cost. And then, here's the purchase prices of the homes, and you could see them here. Now, these are what you'd call manufactured dwellings. And again, in this, the homeowner, they purchase the home, but the land and the servicing, it's owned and operated by a private entity that you'll pay a lease portion to. Some issues around these types of development are two in particular, especially let's say in more sort of developed communities like Ottawa, maybe Toronto. Most of my experience is in Ottawa, but some of these sites get threatened with redevelopment. So what that does, one, it creates a little bit of instability for homeowners in this particular, in those particular neighborhoods. Not all of them. Some of them are very stable. But this has also led to some traditional mortgage lenders not really being too favorable to these types of models. Now, I can't talk in much detail about the CapREIT model that I'm showing you here, but we might be able to assume that they've come up with some agreement or longer-term leases to satisfy lenders who might be buying into this particular community. Next slide, please. And this is a typical example of land lease model. So it's, what you might consider to be a mobile home park, etc. There's been a lot of movement I've noticed, in the last decade towards tiny homes and modular construction. And I think a lot of people forgot about this particular model. And there are similarities between this type of dwelling versus the other ones, although the architects in the room might cringe a little bit when they see the manufactured homes. And again, I think here we've got some societal issues that we'd have to tackle about acceptance of this type of dwelling and so forth. And in the last slide we could see a little site plan there, but again, it's something that could be considered. Some of these communities, they're very tight-knit communities, they're very well maintained, and they're a secure, stable source of affordable housing for the homeowners that live there. Next slide, please. So another option that we're looking to discuss and consider tonight are community land trusts. Now, this is very similar to the model that I had just showed you with CapREIT, but in this particular case, the community land trusts are usually, the land is owned by a not-for-profit, tax-exempt organization that provides affordable housing. And again, the land trust allows people to purchase a home while the land beneath them is held in perpetuity by the trust. There is a community land trust that's recently been incorporated in Ottawa. I know they're looking to grow and develop, but it's I think there's multiple reasons why these maybe have not necessarily taken off in Canada. I think perhaps out west there may be some examples. And again, I'm not that familiar with this particular model, but the ground lease typically includes three restrictions. First, the home must be occupied by the owner or the household or family. Secondly, the land trust must retain a preemptive right to purchase the home if the owner wants to sell. And third, the resale price must be calculated by a defined formula. And while I'm familiar with some of these characteristics in other housing developments, I could say that these, especially the sort of sub-bullets B and C, could create some issues between the land trust or the not-for-profit agency and purchasers and sellers of the units. I've seen some examples in the past. Some of you might be familiar with Centertown Citizens Ottawa Corporation. They actually did a model somewhat similar to this. I think it was a long time ago, year 2000, 1999. This is before I actually moved to the city of Ottawa, but just talking with the people that were involved in that, even though it was successful in terms of getting people into affordable home ownership, I think if you sort of evaluate the program, it was administratively a heavy burden on the organization to continue to operate that over its life, and probably still is. So despite being successful, it's very complicated. Next slide.
Hi, I guess that's my cue here. So hi, everyone. So CMHC has a couple programs that support, those looking to get into home ownership. So here today we have two. One is the rent-to-own stream from the Affordable Housing Innovation Fund, and we also have the Shared Equity Mortgage Providers Fund, or SEMP Fund. So the thing to note first about these two programs is that unlike some of the programs you've heard today from previous speakers, these two programs are actually direct to housing providers. So the government through CMHC is essentially supporting or offering another path to home ownership, but through housing providers. Like if you're a household and you're looking to apply to one of these programs, you'd have to go through a housing provider. Now, first with SEMP on the right there, there's two streams to it. The first one is called the pre-construction stream. And so it essentially, it supports new housing projects, the construction of new housing projects in which shared equity mortgages will be offered. And we recently, well, not recently, but there's one example in Toronto, where this was offered in a building with around, I would say 200 units, condo units. And we've heard from the beneficiary of the funding saying that one of the sweet spots about SEMP is that it's not, there's no limit on incomes, because sometimes you see with affordable housing programs, there's like a limit to a household's income, but they want to apply. And, the general idea is that, the program should benefit households with, lower or modest incomes. But, imagine you're, you and your partner, and you're looking to maybe start a family in Toronto, and you're looking to buy a 2 or 3 bedroom condo, which we know is pretty expensive, just because they're not as available. And so because SEMP isn't limited by income, the beneficiary of this in Toronto told us that they were able to offer shared equity mortgages through SEMP, to people looking to buy these bigger, larger, and more expensive units. Even people with, pretty decent incomes, but just which, just 2 or 3 bedroom condos are pretty expensive for them to afford. Um, and on the bottom there, we also have a second stream to SEMP, which is the shared equity stream. So this is financing us financing housing providers that provide share equity mortgages, and it just expands their financing capacity so they can offer more share equity mortgages to people. Now, on the left there, we have the rent to own stream. So it is a stream under our Affordable Housing Innovation Fund. And to provide a bit of context, the Innovation Fund, the first round was actually started in 2016. And it's, I guess you can call it philosophy, but the philosophy is to sort of test new ideas in the affordable housing sector. Ideas that, are disruptive, that may evolve the industry and allow us to learn something, but which, might be a little bit riskier and might not be able to qualify for conventional funding for these ideas to be tested. And so through this fund, we're able to test new models, whether it's financing or building models, to sort of, again, like evolve the affordable housing sector. And so the rent to own stream was recently launched about half a year ago, and it sits under the Affordable Housing Innovation Fund. We're looking for ideas, innovative ideas in the rent to own space to test. And proposals will have to demonstrate 3 things. So innovation, that's already explained. Affordability, we're saying, some or all of the units in the idea proposed should be affordable, and also financial sustainability. And that just means, we're looking for viable business models, so to speak, stuff with a proof of concept. Yeah.
Excellent. Thank you. Thank you, Jennifer. And we'll come back to some of these, I think, during the discussion as well, when we talk about, some ideas to how we can accelerate, the development of more rent-to-own scenarios and second mortgage options. So, thank you. Next slide. And to start to sort of get to the end of the presentation, we'll talk about just the last two incentives or options. This one is borrowing against RRSP. So this is another federal program, the Canada Home Buyers Plan. And in this case, a home buyer, and some of you might be familiar with this already, this is a program that allows you to withdraw from your registered retirement savings to buy or build a qualifying home for yourself or for a related person with a disability. And you can withdraw up to $35,000, and your RRSP issuer will not withhold the tax from the funds you withdraw. So basically, if you had $35,000 in savings in your RRSP account, and if you withdrew those today, you would have to pay taxes on that withdrawal. But in this case, you could use that towards your down payment. So if you're participating in any of these programs that we're talking about, this is another means to provide that equity into your home. And then you do have to pay that back into your RRSP account, but you have the benefit of saving or not having to pay back the taxes that you had recouped from putting that savings away in the first place. And again, this line of I'll call it equity, but it's a potential down payment. It can be applied to freehold condominium, freehold units, condominium units, or equity co-op units as well. Just to note, this added with the 5% down payment requirement, extended amortizations, for example. There was a point in the past where the government did extend the amortization period from 25 to 35 years. I don't know if they'll consider that again, but there are mechanisms that could be looked at with second mortgages to help make home ownership more affordable even within this context that we're in today. Ben? That's correct. Thank you for that. Yes, it is. Okay, next slide. All right, so now we're going to talk a little bit about rent to own, and I mentioned it with Habitat, and that's a very particular circumstance. This is a more of a private sector model, and this was actually, I learned about this very recently, Ben and I, from a private real estate agent, and I just want to give him some credit. He's not able to be here tonight, as his website is here though, johnnyhunt.ca. But in any case, this is really sort of talks about what CMHC is trying to promote, and a lot of what we're discussing right now about how to help millennials get into the housing market. So a rent-own agreement is it's a deal in which you commit to renting a property for a specific period of time with the option of buying it before your lease runs out. The rent-own agreements include a standard lease agreement, and they could also include an option to buy at a later time, and I'll touch on that in a moment. Lease option contracts give you the right to buy the home when the lease expires, while lease purchase contracts require you to buy it at the end of the lease. So one is kind of open-ended, you could walk away. The other one is not, you must buy it at the end of that term. You pay rent throughout the lease, just like you would on any other rental property. And in some cases, a percentage of that rental payment, it's applied to the purchase price. So at the end of the lease period, maybe if you put $5,000 or $8,000, down through your rent, as part of your rent payments, that gets added against the purchase price with your down payment when you get to purchase the home. And then with some rent-to-own contracts, you might have to maintain the property and pay for repairs, just as if you own the property yourself. So next slide. So who's involved in a rent-to-own type of agreement? So in this case, you have a tenant. Usually these agreements, and again, these are private sector agreements, they run for about 3 to 5 years. And then you have an investor, somebody who's willing to buy the property for the tenant and rent it to them until the option to purchase is exercised, which means at the end of that term, they buy the property. You need a mortgage broker who will qualify the investor for the purchase and to work with the tenant to ensure that the purchase will happen in a 3 to 5 year period. Could be longer, but we typically see 3 to 5 year periods. A real estate lawyer who's familiar with this, because you need very specific types of agreements to meet both the investor and tenant's needs and legal responsibilities. Realtor's example to understand how this works and to match tenants with the right properties and sometimes investors as well. And then also, home inspection is really important in this case because you want to limit the risk to both the investor and the tenant, who's going to be the future purchaser as well. Next slide. So how does the rent-to-own program work? So often this is very popular with people who may be struggling with their current credit rating, new Canadians who have to build credit, and so forth. So in this particular case, the tenant would have to qualify for a specific rent-to-own program, but you need a realtor and when I say a lender, it's more like an investor that's willing to cooperate or operate in this particular space. You put an investor package together to find someone who's interested in doing this. And this would work in your typical housing market context, where let's say a house is priced at, or a property is priced at $400,000, and you have an agreement with the tenant that in 5 years they're going to buy that from you for $460,000. The investor would buy the property, and then the tenant would pay all of those carrying costs until the end of the 5 year term, when they should have better credit and they could purchase that from the investor. And then the investor makes that appreciation, it's kind of a guaranteed appreciation after the 5 year term. And again, we'll get into this a little more. In the normal market context, this works out really well. I think in today's context, it does become problematic because we've seen such a steep escalation of house prices. So here the tenant finds their home on their own. The investor buys the home for the tenant. They both perform the inspection, and the investor ensures that the property closes on time. The tenant agrees to rent it from the investor for the 3 to 5 year period, and the rental price doesn't usually increase within that period as well. And again, the tenant has the option to purchase that home at an agreed upon price in 3 to 5 years, and a portion of the monthly rent is applied as a lease option to that credit. This was fairly popular, or before before the pandemic, we heard from some real estate agents that were participating and had investors willing to do that. But what we heard from the realty sector currently is that, again, because there's no guarantee that, if you buy a house today, especially with interest rates rising, other sort of pressures on the real estate market, that $500 or even $800,000 property now is going to be worth more in 5 years. So that's putting some complexity into this model. But again, that's why we have these other programs and some folks on the panel to discuss that just now. So we're wrapping up the presentation. So we're going to go to the last slide. And so how can governments help millennials purchase homes? So we're going to start to have a discussion and take some questions. Mushtaq, if you could maybe join me up here. And we do have Jennifer and Gregory remotely. And Ben, are you going to join us as well? Thank you. Okay, great.
Yes, thank you. So, homeownership alternatives works with options for homes. Um, the the model is a shared equity, so that shared equity is both up and down. So, in a down market, what happens is we will reduce the amount that's payable by the percentage that the property has decreased in value. So if the property has gone down, in fact, 20%, then we would reduce the amount that the purchaser would have to pay by 20%. It doesn't actually eliminate the total amount that's due. And the way we do that to ensure is that every fiscal quarter, we use an outside organization to help us do the valuations. It's an appraisal company. So we do valuations of all of our developments. So we have a great idea of what the market value is. So if someone comes and says that they want to pay back the second mortgage, um, and say it's a voluntary repayment, we already know we already have an idea what the market value is. So we would take that into account. If you're selling the property and you're actually selling it at a loss, because we do the valuation, we will have an idea of what it is, and if it in fact is a loss, we will reduce the amount that's payable by the corresponding decrease in value. Does that answer your question? Sorry, I didn't get the first part of your question. So, mhm. So the way they would call on it is if you are in default. You're saying, if you're in default, then you're in default of your second mortgage. If they call on it and saying that you need to put in an additional amount of equity, that's not a default on our second mortgage. So you would have to find that money to put it in. If you cannot find the money, and then you would have to sell, and then when you sold the property, then you would have to, from the proceeds, you pay back the first mortgage, and then the remainder would be used to pay out the second mortgage that would opt with us. Hello? Did you get that? Did I answer your question? Okay. Mhm. Okay. Well, if do you currently own a home with options for homes? Oh, okay, okay, okay. I see. I see. Okay. Thank you.
Uh, sorry, do you mind repeating the first part of the question? I really didn't hear anything.
Oh, yeah. And in fact, Jennifer did allude to the SEMP funding, and we were the organization that applied for those funds. So we get funding we have our own source of funds. That was an endowment from a woman by the name of June Callwood. We also apply for funds through municipal affordable housing programs, such as what the acronym is HOAP, Home Ownership Assistance Program, from different municipalities, as well as was Saeed said at the beginning of the presentation, through development charges. So we layer all of these different sources of funding together, and we have one second mortgage that we can lend out.
Sorry, like I gotta say, like the sound is really echoey. Like I don't know
Yeah,
about you, Greg. Like
yeah,
I
same
couldn't
thing.
hear anything. Uh, me and Greg, we can't understand what you guys are saying. It sounds muffled. Wait, Greg, can you hear me?
I can hear you.
Okay. Um, okay, yeah, I think this is great. Everyone can hear me now. So yeah, the SEMP stream that I had alluded to earlier, so the pre-construction stream for our shared equity mortgage providers fund, um, it does like nonprofit organizations can apply to it. So can municipalities, provinces, and yeah, it applies to nonprofits and it helps with pre-construction costs. So we're talking about low-cost loans for example, site assessments, environmental assessments. If there's an option to buy a piece of land for you to build a new project on, that applies as well. So yeah, it's meant to help, lower the amount of barriers to increasing housing supply. And to date, there's been about, I believe, just under 30 million spent on that stream. Yeah.
Can I?
Yeah, that would be an example of a project we would fund through that stream.
Most definitely. As a HOA is also a nonprofit, not-for-profit organization, so we actively encourage other nonprofit developers for partnerships. That's always our first step. So if you're a developer and you're a nonprofit, yeah, come talk to us. We'll be happy to review your proposals and see what can be done. Yeah, what HOA is finding is that there's a big appetite as well from for-profit developers to get into the affordable housing space, or sorry, I shouldn't even say affordable housing, more attainable housing space, because it's a big push. Housing as across the country, housing affordability is a big issue. So everybody's looking at ways to improve the affordability of housing. So yeah, we're seeing a big push, and a lot of people are trying to contact us to see what can be done and how we can form partnerships in that regard. Thank. Okay, I wasn't able to hear you properly, but I think I got the gist about you asking about how our sales were going through the pandemic, and with the higher interest rates, well, if we've seen any differences. It's very interesting, that question, because we went into sales with a development right at the beginning of the pandemic, and we were very sure that the purchasers at the time, and because our closing is coming up this summer, would be looking to get bigger second mortgages and more assistance because the interest rates have increased. What we've actually found is a lot of people are actually now coming to decline their second mortgage because they had an opportunity during the pandemic to save, and they've put down bigger down payments. So we're finding that they are no longer needing the second mortgage. Conversely, we're modeling out some future developments that are going into construction, and we're feeling, based on the price points of these new developments, we're predicting that a much bigger uptake in use of our second mortgage. We're normally, in the past, prior to the pandemic, we had between a 67 to 72% uptake in the second mortgage usage. And based on the prices that we're seeing right now, and combine that with the higher interest rates, we're predicting about an 80% uptake in the second mortgage program that we're going to be offering. The other thing I want to say is we're always talking about the interest rates, and the thing that we need to put into perspective is that the interest rates that we're actually seeing at the banks and financial institutions, they're actually the normal rates. The rates that we've had in the past were actually really, really low. And so, 6%, 7% are standard rates. So, and for our program, the big issue that we're finding is trying to hit the income levels that are below the 60th percentile, because really and truly, we're looking in the city of Toronto for a single individual to be qualified to get assistance is $82,000. A family of two individuals and at least one child is $127,000. And sadly, having an income below, the last time I ran the numbers in January, below $75,000, it's just really, really hard to qualify for a mortgage. And people who have lower incomes, sadly, the only way that they can really afford to purchase is they have to have a very large down payment, because they can't qualify for enough mortgage to carry these big they can't qualify for enough mortgage because the prices of these condos are so high right now. Right. This is the thing. It's tough. It's very difficult, and that's why at least in the city, that they're kind of drifting away from the term affordable housing, and putting it more to attainable, because the demographics of what we're seeing is that there's a lot more white collar individuals earning, like people earning between $80,000 to $100,000, coming to get down payment assistance, because it's not, they have good incomes, they can afford to make a payment on a $3,500 mortgage, but they just can't scrape enough to come up with a down payment because of what you just said. The rents are so high.
Yeah, I'll just add, I think the question was about rising interest rates, if I didn't hear incorrectly. And yeah, we're like CMHC, you know, we're trying to understand, how this impacts our programs, our delivery, because when rates rise, it's not just increased borrowing costs for the borrow for home buyers, right? It's also increased labor costs, it's increased cost of construction, and so this is affecting housing from several different angles, and we're just trying to better understand that right now. But I think I don't have a crystal ball, but I think that these changes in the macroeconomic environment will probably mean these alternative home ownership models are gonna see more interest. I think we can say that for fairly certain, right? Like it's not just SEMP or people's interest in rent to own. We also have a program called the First Time Home Buyers Incentive. It's been around for a while, so I think it's safe to say we'll see upticks in applications for that.
if I may weigh in on that as well, I think one of the biggest things that everybody keeps overlooking, governments included and developers, is I know at least in the GTA area in Toronto market, building is very much concentrated in the downtown areas and in Toronto proper. I think people need to start looking, their developers and government need to start looking at other secondary markets that surround, say, and I'm just talking about GTA, I'm not familiar with the Ottawa area, but areas that surround the GTA, even out like going out to like Windsor, north in the Barrie area, and then focus on transit because you build out there or you have transit. The big issue is to move people in and out of your city corridor because a lot of people work in the city. So if you have transit alternatives, not highways, but rapid rail or rapid transit systems, then you can have communities that are outside of the area, and then you can bring people in and out easily, and that could be a possible way to actually reduce housing prices and the pressures, because as we all know, land is finite, and the more demand there is for a specific spot, the higher that price is going to be. So expand. Canada is a really big place. We have lots of space, and the majority of our population is crammed within 200 kilometers of the U.S. border. I didn't.
Sorry, I just wanted to add, like, to that question earlier about where CMHC gets financing. So our programs are financed from Crown borrowings. We borrow directly from the government's loan program. But yeah. It depends on it's Crown borrowings. So it really depends on the program. Like if you're asking about a specific program, just shoot me an email and then we'll be able to answer it. But it's generally the answer is Crown borrowings.
Yeah.
Record.